Welcome again on our third session on IFRS 9 financial instruments. And I think today we have an interesting but challenging topic, which is hedge accounting. I'm not sure that a lot of companies do apply hedge accounting because maybe because of the complexity, maybe because of the documentation requirements, or maybe for other reasons that they don't know how hedge accounting may help them in the accounting and presenting certain transactions which are hedged. So today we will have hedge accounting. This will be given by Hans Everard, and he will guide you through the standard IFRS 9 for hedge accounting. A part will be theoretical, and there will also be quite some examples with accounting entries for example, cash flow hedges, fair value hedges, and etc. So these are the logistics. I think they're standard. Again, we have uploaded the slides in the handout section. There's one additional slide and there's one additional Excel. It all starts with the date, so you can see which one it is. But I see also that all the other handouts from the previous sessions are also present. And first of all, I want to notify you also something else, is that we have added a fourth session. I hope you all can join it because of two reasons. I don't think we have finished everything with regard to liabilities versus equity, which was the second session. So we have terminated the session because we were coming to the end of at that time. We didn't discuss also derecognition, so we want to discuss also the derecognition, for example, factoring, and then we would also guide you through the disclosures for this. So this is scheduled. You should have received a new email from GoToWebinar that an additional session has been added. It will be the same link. Okay, so I will give the word now to Hans, and Hans will guide you through IFRS 9 hedge accounting. If there are any questions, don't hesitate to ask them. Good luck, Hans.
Thank you, Sam. So indeed, hedge accounting, a challenging but interesting topic of IFRS 9. As said by Sam, we'll first go through some theoretical aspects, as IFRS 9 has foreseen a number of concepts and terms which should be known in order to apply in practice then hedge accounting. But as said by Sam, we will give some practical examples also as given in the Excel files, which makes the effect of hedge accounting a bit more clear. So what is the objective of hedge accounting? Basically, it's to represent in your financial statements the effect of the entity's risk management. What does that mean? Obviously, that a company that wants to apply hedge accounting will need to identify first the specific risks for the entity, then set up a strategy to cope with the identified risk, and then break down the approach per risk in order to plan to mitigate those risks. So creation of risk management is essential and also related to that, the documentation on that. So it's an instrument to mitigate your financial risk and also present that in your financial statement. Both are obviously related, and you cannot do hedge accounting without risk management. It's an option, so there is no requirement to do a hedge accounting, but obviously it has some advantages. Next to that, there is tougher documentation requirements and so on. So first, step back, because hedge accounting is IFRS 9, but a lot of people might have memories of IAS 39, and there is still IAS 39. So there might be somewhat confusion. Are we now relating to IFRS 9 or IAS 39? Well, in principle, it's clear. IFRS 9 has replaced IAS 39 since 2018. There has been a lengthy path to draw up IFRS 9, going back and forth with all relevant stakeholders. But in the end, IFRS 9 is there, so it has replaced IAS 39. There is one specific aspect that has not been covered yet in IFRS 9, which is solution for dynamic risk management. It's a bit more complex aspect of hedge accounting, and basically it's mostly done, not necessarily only, but mostly done in banks and insurances, where they do macro hedging on larger portfolios and so on. As IFRS 9 does not foresee all specific tools to cope with proper hedge accounting for those macro hedges, the board has allowed the possibility to still apply IAS 39 in that respect. Also, next to that, although IFRS 9 has fully been replaced IAS 39, except the small part I just explained, a lot of practical implementation guidance, which was set up and created at the time IAS 39 only exists, is still valid under IFRS 9. So it's not because IFRS 9 has replaced IAS 39 that all the implementation guidance is gone. For purpose of this seminar, we'll focus on IFRS 9 requirements. So why do companies hedge? Well, most common, but there is a huge variety next to the 4 examples I've listed here, is basically to cope with risks, interest rate risk, foreign exchange risk, credit risk, equity price risk, but you can be really creative if you want to hedge for a specific risk. So the list is certainly not fully complete. You can hedge items that are financial instruments, but also non-financial assets or liability can be a hedge item. Why do hedge accounting? Well, basically, the goal is to correct deficiencies that would otherwise arise in your financial statements, given the fact that your hedged item will evolve in a specific way following the accounting requirements of that hedge item. And on the other hand, your hedge instrument, which you've created to cope with the risk of your hedge item, could evolve in another way. There are 4 broad categories that can be identified, and let's go through them one by one. The first one is measurement difference between, on the one side, the hedged item, and the other side, the hedging instrument. So, as an example, for example, there is a euro functional entity that has a firm commitment to acquire a machine in US dollar in a few months. In order to be sure on the accounting treatment, because in the end, that machine will run in euro in its books, they want to fix the euro dollar exchange rate at the date of the commitment and not await the evolution of the FX rate until the moment the acquisition actually takes place. So what do? They close a fair value hedge contract, a forward contract, to ensure that at the moment the acquisition takes place, it is at the fixed euro rate in the books. Later on, we'll go through in more detail on that example. A second example of why deficiencies should be corrected is performance reporting. If the evolution of a fair value of an item goes through OCI, but on the other hand, the evolution of your hedging instrument would go through P&L, then at that moment you have a mismatch because part is in OCI and the other one is in P&L. So in order to cope with that and apply hedge accounting, you could make sure that both are in OCI or both are in P&L. A third category is recognition differences. Basically, at that moment, you want to ensure that the cash flows that come over are covered. And recognition differences, it's the case because at a certain moment, your hedge instrument could already be on your books, but your hedged item is something that will run into your books at a later moment. Example we have here is a lessor who has a foreign exchange dominated operating lease. So the future unrecognized contractual rentals are not yet on the books, but an entity wants to make sure that those foreign rentals will come into the books at a specific rate that they want to hedge now. Applying hedge accounting, you can make sure that there is a timely recognition at the same moment, or at least the mismatch is covered in one way or another. And then the next one is about existing differences. Here there is a future sale expected, and you want to hedge it by a forward FX contract. As you can see, I've listed below the last two are cash flow hedges, the first two are fair value hedges. I will come back on that more in detail. What is now the difference between fair value hedges and cash flow hedges, and also what is the related impact on accounting treatment using hedge accounting. Let's go to the example of a fair value hedge, the machine. So here specifically, an entity plans to acquire a machine for $1 million US, and at the date of the commitment, the euro-dollar rate is at 0.9 euros per US dollar. They want to fix that rate because, and eventually it would result in that, at the moment of the acquisition, the FX rate has increased up to 0.95. So what happens applying non-hedge accounting if you would have a hedge instrument and you would have such a situation? So not applying hedge accounting. For the rest, example is the same. Basically, at the initial recognition, the fixed asset would be at 950K using the exchange rate which is existing at the moment of the acquisition. At the same moment, the forward contract will have increased in value, so you will have an asset of 50K, which will eventually result in a profit in your P&L of 50K. Here, the asset base of 950K will go through again in P&L based on the asset's useful life and then through depreciations. If we would apply a hedge accounting on the other side, there again, initially we would recognize the fixed asset also at 950K because that's the FX rate at the moment of the acquisition. And the forward contract would also have increased up to a value and an asset of 50K. However, applying hedge accounting, at the moment the fair value of the forward contract would increase, it will hit P&L, which is similar to non-hedge accounting, but on top of that, applying hedge accounting, the fair value of the firm commitment at that moment would also increase and offset the increase of P&L, the profit on P&L would here offset the other side. And upon settlement, the firm commitment, which would have increased up to 50K, which is the delta between what was foreseen here in the fix at the moment of the commitment and eventually the 0.95, would be offset with the carry amount of the firm, with the carry amount of the machine, and eventually would result in only a recognition of 900K asset. So this way you will avoid the mismatch you have in applying non-hedge accounting, because here the charge will result over the useful life of the asset and you have a one-time profit resulting from your forward contract. What are now the criteria if you want to apply hedge accounting? You will see different terms again. In the next slides, I will go deeper on the different aspects of those terms. So first, there should be a hedging relationship that only consists out of eligible hedging instruments and eligible hedged items. So it's clear that only eligible instruments and items can be used to apply hedge accounting. We'll explain further what are those eligible instruments and items, and also I'll give some examples related to that. A second criteria in order to apply a hedge accounting is that there should be a formal designation and also documentation of the hedging relationship, which is the two items explained above, the risk management objective, and the strategy for undertaking the hedge. The documentation is quite extensive, and obviously it's not only related to what you will include in your financial statements. There should be underlying, for internal purposes, a formal designation and documentation available to support the hedge accounting principles being applied. So 2 of the 3 criteria already. if we move to the third one, the second criteria has a third point. There is also the hedge ratio of the hedge relationship that should be the same for quantities of the hedged item that the entity actually hedges and the quantity of the hedging instrument. Here I will give a specific example later on which will make it more clear, but it's possible that the quantity of a hedge items differs from the quantity of the hedging instrument. However, if your hedge ratio should be adjusted then not to a one-on-one, but to the actual ratio. It will become a bit more clear if we go to the example. So here, the economic relationship. So one of the criteria there is that there should be an economic relationship between the hedged item and the hedging instrument. For example, here, if an entity is exposed to risks in two foreign currencies, the US dollar and the Hong Kong dollar, it could be any other US dollar linked currency, and they only use US dollar linked hedges to hedge both of FX risk exposure, then there is an economic relationship because the Hong Kong dollar is linked to the US dollar. Obviously, if we would have another foreign currency which is not linked to US dollar, it might be more difficult to defend the economic relationship. So here, in a specific example, even though you're hedging two different foreign currencies with only one hedge to one currency, there's still the clear economic relationship. All will depend on facts and circumstances that exist for the specific risk you want to hedge and the way you would like to hedge it. The hedge relationship first criteria is the economic relationship. A second one is that the credit risk cannot dominate the value change. There is no clear definition in IFRS 9 on what is dominate. However, an example here that can be given is if an entity sells a specific product to a customer abroad, which all are dominated in a specific foreign currency, and in that area there are no alternative customers, or at least also no alternative possibilities to sell the product in that same currency, well, the credit risk of that particular customer would influence quite a lot the forecasted sale occurring in that currency, because there is no alternative customer available. At that moment, it would be difficult to explain the effectiveness requirements, given that the credit risk of one client is clearly dominating the situation. And then the hedge ratio, and that's the same definition I explained earlier of the quantities. So let's try to explain it here, because it's a quite complex explanation, by using an example. An entity purchases raw materials, and they know that the price of those raw materials is usually at a discount compared to the commodity benchmark price they want to use to hedge the raw material price. So, and that's the second bullet, is part of the documentation that will have to be prepared. The company can demonstrate that both, even though there is a discount, remain highly correlated, and they can use that discount. So at that moment, there would be a reason to divide from the one-on-one hedge ratio, because for each notional amount of 1 ton of a forward contract, they would link it to a highly probable forecast purchase of 1.25 tons. And the delta between the 1 ton here and the 1.25 here is basically the link here, the discount rate, which they have been able to demonstrate the highly correlation between both. Here again, there are numerous, but in most cases, the hedge ratio will be 1:1. So moving to hedge accounting and key concept. So first one, as said, essential to be able to do a hedge accounting is to identify a risk management strategy and also the objective for a particular hedge relationship. What should be included, and I'm a bit repeating what I said at the start, your risk management will typically include what are the risks that the company faces, how the company wants to respond to those, and in most cases, it's in place for a longer period, but that doesn't mean that your risk management strategy cannot include some flexibility to react to changes in circumstances. Last year is clear an example where certain circumstances could change the risks the company is facing and also how to respond to. So it's not necessarily it's fully fixed. There can be some degree of flexibility. If we go deeper, then you have the risk management objective and the risk management strategy. It's clear that the objective is a level lower. So it could be that the risk management objective for a specific hedge relationship changes over time, even though the risk management strategy remains the same. So given evolving circumstances, a company could say, we still want to cope the same risk. However, we believe that the objective to get to there is changing. The change in risk of management objective could lead to the hedge accounting for that specific risk management objective to be discontinued. But obviously, at that moment, you might encounter a new risk management objective with another hedge relationship that again can be used in the hedge accounting. What are now kinds of hedges? As said in the beginning, there are different types of hedge relationship. We already saw two of them. That's the fair value hedge and the cash flow hedge. But there is also a third one. That's a hedge of a net investment in a foreign operation. If we look at the fair value hedge, the clear goal is to ensure that the fair value of a specific asset or liability in the books, it could be unrecognized yet, but it's clear that you want to ensure that the fair value of such a future asset or liability or a portion of any of the above is insured. So you will make sure that using your hedge instrument that any changes in the fair value of any of described here would be compensated by the evolution of your hedge instrument. It's attributable to a particular risk, and that is then the risk you will be hedging, and it will affect the P&L. An example here is an FX forward contract of a swap to hedge an FX position for a long-term trade receivable in a non-functional currency. Because if your receivable would decrease or increase, for example, following the foreign currency, your hedge instrument will evolve in the different opposition, and that way you can ensure that the fair value remains the same applying hedge accounting, but because the delta that is created on your hedged item will be compensated, and applying hedge accounting, you can do that on the line of your hedge item, so the fair value remains stable. Those are fair value hedges. The second one is cash flow hedges. If we look at that, the clear goal is there to ensure that the future cash in or outflows are fixed at a specific rate. So you want to ensure that the cash outflows or inflows will be at a fixed value and are not exposed to specific variability. A typical one we have here is an interest rate swap where you exchange a variable interest rate to a fixed interest rate or an FX hedge of a forecasted sale transaction. There are situations that obviously both could be explained. It could be a fair value hedge or a cash flow hedge, but here you go back to your risk management strategy, and the clear way will be to see okay, what is the eventual goal the entity has in their risk management strategy that will drive them further to make the identification. Is it a fair value hedge or is it a cash flow hedge? The third category is the hedge of a net investment in a foreign operation. And if that's based in a country or currency that is other than the reporting entity, then obviously you're exposed to foreign exchange risks. So there could be hedging in place as well. Looking at the hedge relationship, what are now eligible hedged items? So going back a few slides where I said in order to have a hedge relationship, there can only be eligible hedged items and eligible hedge instruments. In order to qualify as a hedged item, the hedge should create an exposure to risk that ultimately will affect the P&L. So the risk should eventually run into your P&L. The hedged item can be a specific asset or a liability, group or single one. It could be an unrecognized firm commitment, even a highly probable forecasted transaction, or as said, the net investment in foreign operation. The most internally generated intangibles are not recognized assets, and therefore they cannot be hedged items. So internally generated assets are mostly difficult to qualify as hedged items, even though for commitments can be done according to IFRS 9. In respect to the highly probable forecast transaction, there is no clear definition in IFRS 9. The most common interpretation is the likelihood is happening more likely than not. So there is some flexibility, but it's more likely than not. Next to being one of those 4 items as listed before and ultimately affecting P&L, the hedge item must be reliable, measurable, and also it can be a component of any of the above. I will come back on the component aspect later on. Hedged items intra-group. So it is possible to design a hedged item if it's an intra-group transaction, providing that it ultimately affects the consolidated P&L. So even for intra-group transactions, you could have hedged items, but then the consolidated P&L should eventually be affected. So in principle, only, and that's the same list as we discussed with before, with external parties qualify for hedge accounting, but there is a specific exemption for intra-group items. So a hedge of the foreign currency risk of an intra-group monetary item and the foreign currency risk of a highly probable forecast intra-group transaction. When it comes to financial liabilities containing embedded derivatives that are accounted for separately, the hedged item would be the host instrument or the components, and not the hybrid of both the financial liability and the embedded derivatives. If an embedded derivative is only accounted for separately, then it would mean, according to IFRS 9, and I think we touched based on that already last time, it's not closely related to the host instrument, and then it's very unlikely to meet the criteria for an eligible aggregate exposure. So here it will be the host instrument or a specific component of the host instrument. Component designation, and on the next slide I will have a more detailed example which might make it more clear. Applying hedge accounting, an entity could not designate a full fair value change, but only a component of that. So a component is less than the entire fair value change or cash flow variability of an item, so only specific aspect. And then obviously you can designate only that component, and only to that component the hedge accounting requirements will apply. It could be a specific risk that results in changes in cash flow or fair value. It could be specific contractual cash flows that have been foreseen, or it could be components of a nominal amount. Let's make it a bit more clear on the next slide, but again, and that's listed here below, the same requirements apply. It should be a reliable, measurable when the risk component and not only the full item. So explanation here, a company would buy calls, and the price setting for the call as foreseen by the contract is based on a variable price linked to specific benchmark. It's explained here, the Newcastle coal terminal. And next to that variable price for the coal, there is also a logistics charge, which is also again linked to the Baltic Dry Index. The company has specific purchase quantities foreseen for each month for a specific period for which they want to apply hedging. However, the company doesn't want to hedge the full item. They don't want to sell the full purchases of the coal. The only component they want to hedge is here the specific variability in the coal price linked to the coal benchmark price. So the changes linked to the Baltic Dry Index for the logistic charges are not something that the company wants to hedge. So at that moment, you're only hedging one component and not the full item. You could also have a group of items, providing that the individual items comprising that group would by itself qualify for hedge accounting. Important there as well, and then we link back to the risk management, is that the groups are managed as well on a group basis. Example you could have here is if you have a specific portfolio of shares, for example, linked to a specific market like the Swiss market index, then a company could elect to say, okay, we account for those portfolio of shares at fair value through OCI, which is a policy choice you have in IFRS 9, with subsequent reclassification to P&L. All of the individual shares would need to be eligible hedged items. So considering that would be the case, the entity could say, okay, we designate the full portfolio of our shares as a hedged item and have future contracts in order to cope potential risk. As a result, your gain and losses on your futures you have contracted as hedge instrument will also be accounted for in OCI, with, however, no subsequent reclassification to P&L. But at that moment, during the lifetime, you will eliminate the accounting mismatch which would otherwise arise, given the fact that without hedge accounting, the evolution of your future contracts would go to P&L and not to OCI. What are hedge group of items? There could also be a net hedged position. That's a change to IAS 39, where IFRS 9 foresees a possibility that hedge accounting is done on net positions, so that net positions are designated as hedged items. There are a few restrictions, however. It's only possible if, and that's similar, and it always links back to your risk management. If you want to do it for your hedge account, it should be in line with the way you do it in your risk management. So the hedging should also be in your net basis for risk management purposes. So it cannot only be to do a specific accounting outcome, you need to be consistent between your risk management strategy on the one side and the way you apply your hedge accounting on the other side. An example here could be if a natural hedge. If a company with a euro functional currency anticipates sales in US dollar for 100 million in the next 12 months, but on the other hand, it intends to purchase fixed assets for $80 million over the same period, then obviously the 80 million of cash outflows in US dollars is a partial natural hedge for the $100 million that come in, given the whole group is presenting in euro and not in dollars. So basically, the idea of the entity would be here that they have a single foreign currency forward to sell the delta, being 100 million inflows of US dollars minus the 80 million outflows you foresee of US dollars. So here there would be a possibility to designate the risk on a net position, being the 20 million remaining US dollars you want to be able to sell towards euros at a fixed price using a foreign currency forward contract. What are hedging instruments? So up to now, we discussed hedged items. Let's now move forward to hedging instruments. And then in a few moments, we will be going to specific examples. A hedging instrument is an instrument whose fair value or cash flow are expected to offset changes in the fair value of the designated hedge items. It links a bit back to what I said before, the hedge relationship. There should be a relationship between the hedge instrument and the hedged item on the one side. And it's required to be one of the following. A derivative measured at fair value through P&L. There are a few exceptions, but we'll not go into detail on that. A non-derivative financial asset or liability that is measured at fair value through P&L. And specifically for a hedge of a foreign currency risk, it can also be a component of that. For hedging instruments, you could also have portions or proportion. The principle is that it's designated in its entirety, and it's only in a few exceptions you could designate a specific proportion of the instrument only. I think there are a few examples here. It's quite technical and detailed, so we'll not go for purpose of this webinar in detail, but the overall guidance, and it's similar to what I said before with the component of a hedged item. If you only designate a proportion of the hedging instrument, then obviously only the designated proportion or proportion will be eligible for hedge accounting. How do you apply then hedge accounting? It's a bit summarizing the whole process run through you have from the start. You first need to identify your eligible hedged items and instrument in line with your strategy. Also, what is the eligible hedged risk you foresee, and to make sure that the relationship is one of the permitted types we explained or as foreseen by Ifrs 9. Once you satisfy the criteria, you can apply hedge accounting, providing that you formally designate it also in your documentation. Here, also important, hedge accounting is applied prospectively, not retrospectively. Looking at the different types of hedge types, let's have a look here. What is now the practical outcome in your P&L when you apply hedge accounting? The first one is the fair value hedge. If you apply hedge accounting for fair value hedges, the carry amount adjusted for fair value with respect to the hedge risk will go through P&L. And in that way, that change in fair value will offset the change in fair value of your hedged items, ensuring that you have a good match in your financial statements. For the hedge instruments, there is no specific, because you simply have an evolution of your fair value through your P&L. and the resultant would go to P&L for the ineffective portion. Important here is to consider for your hedged item, what is the accounting policy there? Is it a financial, a monetary asset or a non-monetary asset? Monetary asset will have changes, for example, for foreign exchange risk, but non-monetary assets will not change once they have been accounted for on your balance sheet. For example, if you have an accounts receivable position that will evolve over time if it's denominated in a foreign exchange, which is not the functional currency of your entity. However, if you acquire inventory in a foreign exchange price, once you account for the inventory on your books, the FX rate will be fixed at the moment it comes on your books, and subsequently your inventories will not evolve anymore because it's a non-monetary asset. So, and it's a typical example there. If you would like to hedge inventory, it can be done for future commitments to purchase inventory, because any changes in your FX rate for future purchases of inventory in foreign currency will be coped by the hedged item. But if you want to hedge inventory that has been purchased in foreign currency, once it's on the books, it is fixed using the FX rate at the moment it came on the books. For cash flows and for net investment, what will happen there, the change to the carrying amount for the effective portion will go to OCI and not to P&L. And that way, there is no variability in your P&L during the evolution of your financial instrument that you use as a hedge investment, but it will only recycle back once the cash flows take place, and that way you avoid the variability in your P&L. The ineffective portion will go to P&L. We'll come again later with a specific example. What qualifies for hedge accounting? Basically, only economically viable hedging strategy. In the past, for IAS 39, and we'll explaining the hedge effectiveness, there was a specific range foreseen, the 80%, 125%. That is no longer the case for IFRS 9. So there is no specific band set forward. It's more judgmental, but clearly if you have too much ineffectiveness that demonstrates that it's economically not viable, then it doesn't qualify for hedge accounting. Also, deliberate imbalances to go for specific accounting treatment are not permitted. How would you need to assess your effectiveness? Because based on the effectiveness, you will make the decision, does it qualify for hedge accounting or not? But also you will do the assessment, what portion will go to your P&L. IFRS 9 does not foresee a specific method. There will always have to be a qualitative assessment, and for simple situations, for simple setups, it might be sufficient, but for more complex, and I explained earlier the example of the calls with the discount, there some quantitative assessment might also be needed, for example, to explain the correlation of the discount between the raw material price and the futures benchmark. The assessment to assess whether you qualify is always forward-looking. It's done at the assumption, but it should also be done at the ongoing basis. So it's not only enough to make the assessment only at the assumption when you first will do hedge accounting. It will have to be done regularly and at least for each closing date, but forward-looking. There is 3 effectiveness requirements, and it's a bit similar things as we explained. So in order to to get more hedge accounting in your fingers of IFRS 9, you will see a lot of things come back, but it's because they always link back to your risk management and also to the practical application. So there must be an expectation for the economic relationship that it would move in the opposite direction. So that's the relationship. When your hedged item goes up, the expectation would be that your hedge instrument would go down. The credit risk, it must not be dominating. I think that was said here before as well. I think another example for a dominating credit risk could be if you have a specific bond with a very high credit risk, then it might not qualify for a hedge accounting. And then the hedge ratio is the quantity of the hedge instrument and the hedged items. The key objectives is to make sure that your hedge accounting is aligned with your risk management objective. It's not retrospective, the effective testing, and you should be doing it ongoing. Let's have a look here at a practical example. And I think I explained it already in definite, but here on one slide you have the summary. If a hedged item will change through P&L for changes in its fair value, and the hedging will instrument, which is expected to be evolving in the opposite direction, will also be have changing fair value through P&L. Obviously, it is linked to the risk being hedged. If there are more things changing in the fair value for a risk that is not being hedged, then part of the fair value will remain uncovered or unhedged in your P&L. I think this is the example we had, and I think I explained it more in detail. Here, obviously, we assume a perfect hedge without any ineffectiveness and a one-to-one hedge ratio. Let's move to an example of a cash flow hedge. Here, what happens there, you have your hedging instrument that is having fair value changes. The effective portion will go through your in OCI, and the ineffective portion will go to P&L. A change compared to IAS 39 is that for non-financial items, and I think that's the example I gave earlier on the inventory, if changes for the effective portion go through OCI, in the past, they could be recycled back to P&L. Under IFRS 9, that is no longer the possibility, and they will remain in OCI. So here, for non-financial items, this might create a mismatch because the effective portion will remain in OCI, and at the moment of sale of your hedged item, the effect will go into P&L.
Hans, can I just interrupt? Yep. I have here a little on your previous slide on fair value. There was a question, but why would we apply accounting for fair value hedge? Because it goes through P&L. And if you would not apply hedge accounting, you also need to measure it to P&L. So why would you apply fair value accounting then? Why would you apply designate the hedge as a fair value hedge? You know,
it's for this example, huh?
No. Yeah.
Because this one is a cash flow hedge.
Yeah, I think it's about fair value hedge. Yeah, the question.
It's a fair value. So I think here the reason why you would apply it is in the utmost right column. So not applying hedge accounting, you will eventually have a fixed asset at a higher, or depending on the evolution of the FX rate, a lower value in your presenting currency, and you will have a profit one-off of your forward contract at the moment of realization here. But here, the higher asset base will result in a charge over time. So you have a mismatch on when the charge goes into your P&L compared to the one of profit. Here, applying hedge accounting, the 50K of forward contract that has been designated to cope with that risk is offset. So you only recognize 900K of asset. So here you don't have the mismatch that exists if you would not be applying hedge accounting. I don't know if that is a question, a response to your question.
Yeah, I think it would be a response. I think it's, if I can add, if your hedged item will be different as a financial instrument, not a non-financial item, then also if you remeasure the non-financial item, it will the financial item will also go to P&L. And that would be different. The only thing I think there will maybe is if it's at amortized cost, you will not do it at fair value. So you may have a change then because fair value can be more than if it's only a FX, more than a FX. So I think that would be a change compared to fair value accounting, hedge accounting, or not. Yeah, okay. I think that will be an answer. Otherwise, we will see if there's another question coming.
Yep. Then
Thank
we'll
you,
see
Hans.
for the next. No problem. So going to a cash flow hedge, let's take this specific situation. So an entity has agreed to sell a machine with a value of 1 million euros, and the contract signed is a sale price fixed in GBP for 740K GBP. Functional currency of the entity is euros, so obviously having a sales contract in GBP exposes the company to foreign exchange risk. They want to hedge that foreign exchange risk for the highly probable forecasted transaction, and they enter into an FX swap where they are entitled to sell the GBP amount they will receive here, the 740K GBP, for in total 1 million. And they pay a premium for that of 50K, which is the fair value at inception. We assume here that the hedge relationship meets the criteria for hedge accounting at initial recognition. So listing that up, if it's a perfect hedge, what happens? The fair value of the hedged item is 1 million euro, which is basically the counter value of the GDP you will get and you will sell in exchange for 1 million euro. And the fair value at that moment of your FX swap is 50K. If we see following evolution, at the moment your hedged item would decrease because of a change in FX rate. So if you wouldn't have hedged it, your 740K GBP would only be worth 925 euros. Then your fair value of your FX swap, which has insured this link, would go up because it would entitle you to obtain a higher one. Same evolution we see here in the next stages. If we look at the evolution, then we see perfect hedge. The decrease here is offset by the increase of 75K here, which results in a perfect match. Same goes here, the decrease further up to June 30th here is offset by an increase in the fair value of your swap over here. And then here we see a slight upward, but then you have the opposite movement. Let's now have a look, and I will be switching to Excel. And I've listed at the left what would happen if you apply hedge accounting, and at the right what would happen if we don't apply hedge accounting. For the rest, starting position is exactly the same. So initial recognition, you have purchased a swap. You recognize it as a financial assets on your balance sheet for both situations, and you will have a cash out of 50. Moving towards the 31st of March 2021, as said, foreign exchange rate is decreasing, so your swap is worth more because you're insured that even for the same amount of GBP, you will still get your 1 million euros and not the lower 925K. Applying hedge accounting, we will post that in OCI. Applying not applying hedge accounting, it will run through P&L. Same happens at June. Again, FX rate is weakening, so your financial asset increases in value through OCI. In non-hedge accounting, it will increase through P&L. And then at 30th of September, there's the opposite movement. Your financial asset decreases in value again through OCI, and for not applying hedge accounting, it decreases through P&L. At the 2nd of October, you will sell. So the sale actually takes place. What do you get? You get 881 euros from your client as a counter value, because you get the 740k of your client, and if you convert it to euros on your P&L, you will get revenues of 881. Same goes for the non-hedge accounting. What happens here? You will get cash for your swap, and the swap will be gone. Same goes here. So jointly together, you have the amount here that came in as cash. So in total, 1,050,000, which obviously is offset by the initial investment you made of 50k euros to buy the swap. And then the crucial difference, not applying hedge accounting, how will your P&L and your balance sheet look like? You will have a total cash movement of 1 million euros that will show up. Your revenues will be 881, and then in your financial result, you will have a net movement of 118k, which is the net of the gain of remeasurement and the loss of remeasurement. So there's a financial income of 118 euros. The net P&L on revenues and financial will be 1 million. Applying hedge accounting, what will happen there is you will recycle the OCI position you build up throughout the life, being the both increases of your financial assets through with an evolution through OCI, as well as the decrease here, which stands in total for the 180k 520, and you will cycle it in OCI towards revenues. So the key difference is applying hedge accounting, you will present 1 million of revenues in your financial statements in euros, whereas not applying hedge accounting, you would only present 881 revenues, but a financial result of 180k with an exactly similar cash outcome, because you have the financial instrument in place. So that is example. I don't know if there are any specific questions on that. If not, let's move further to another similar example with some slight changes. Example here, because the first example was a perfect hedge. Here we see an example. We sell the same amount of GBP and we buy 950k. So notionals are not the same. There is a lower swap FX rate used. There is no premium paid here in this situation. If we look at the evolution over time, then we see that there is a decrease in the fair value of your hedged item, but your swap only increases for 15k. So here you see there is no match because there is a mismatch here, which results in an imbalance of 167. Over time, it decreases, but here the assessment, and it's a judgment that will have to be made each time. There is no specific guidance, but clearly the first one is clearly above, which we need to conclude that it's not effective, so it's not within the range of required effectiveness. As said, it's judgmental. There is no longer the band of 80 to 125% that existed under IAS 39. So it will have to be a position that will have to be substantiated by the company itself. If we move further to another example, then we again have 740 GBP coming in, and we buy 980,000 euros. We pay a premium of 45,000. Here, if you look at the situation, we see some ineffectiveness, but our judgment would be that it is still highly effective, but a portion would need to go through P&L in principle. If we look at the situation here, we see the same. Let's look at this example in Excel, applying hedge accounting and not applying hedge accounting. I think similar here as in the first example, we will first recognize a financial asset with a cash out. That's exactly the same applying hedge accounting or not hedge accounting. Moving further, what happens here is remeasurement is through P&L in non-hedge accounting and is an OCI applying the swap, the hedge accounting, my apologies. Similar situation here, applying hedge accounting is OCI, non-applying hedge accounting, it goes to P&L. And then a slight evolution in the other side here. What happens then? Here we get a cash in, it's at exactly the same rate of 881, and we get a cash in here as well towards revenues. What happens in the non-hedge accounting, the net book value of your FX swap is sold, so you get a cash in return of 135,000. The net cash you obtained here is the 1,016,000 less the 45,000 investment you had up front. So you have a net cash in of 971,000 euros. Your revenues will be 881, and then the rest goes to financial income for 90,000. And the 90,000 is basically the delta between the initial value of the purchased swap less the sales value of the FX swap. Net in P&L 971k, split out between revenues and financial income. Applying hedge accounting, you clearly see here as well what happens, and it's similar to what we saw in the previous example. You see revenues, the cash, and then the recycled OCI that has been built up of 90,000 towards revenues, which result in cash in of 971 and the revenues of 971 here as well. And the delta between the 971 and the initial value foreseen of 980 is basically the ineffectiveness. So then I would think, why don't we see that part already in the P&L? Well, IFRS 9 has given some guidance about under hedging and over hedging. You need to assess what is the cumulative gain on your hedged item. I think here, and I can show it more easily here. The cumulative gain here, what happens is 55,000, then you go to 140, which is the delta here between the 180 and the 866, and then eventually come here. And you also need to make the assessment with what is the cumulative evolution of your FX swap. So here we go in that way. If you compare both, then you see the cumulative gain of your hedged item is each time higher than the cumulative evolution of your hedge instrument. At that moment, the hedge is considered as being underhedged, and there will be no ineffectiveness recognized in P&L. Basically, IFRS 9 only requires recognition at the different steps here, here, and here, in case there would be an overhedge. So you need to make the assessment of the cumulative evolution of your hedged items towards your hedge instrument. But bottom line, you will still get a different outcome as a result of your ineffectiveness, because you don't recognize 980 of revenue, so you only recognize 971. And in that case here, it's only 881, not applying hedge accounting. That was an example with ineffectiveness, but eventually did not run into P&L during the lifetime of the financial instrument, but only at the end of the road. But the clear difference is you still recognize more in revenues applying hedge accounting than not applying hedge accounting, because not applying hedge accounting, a part will go through financial income or financial expense depending on the outcome. I think this is the summary of what I just explained here. And ineffectiveness for overhedge is recognized in P&L throughout the lifetime. If it's underhedged, then it's not recognized. This is for cash flow hedges. For fair value hedges, ineffectiveness is recognized both for over and under hedges. So that's the difference between cash flow hedges and fair value hedges. Moving to a last example is a cash flow hedge for an interest rate swap, where we turn a variable interest rate we have, Euribor plus 2.5%, to a fixed 3%. The evolution of the fair value of the interest rate swap is driven by, on the one hand, underlying market interest rates, and on the other side, the credit risk of the swap counterparty. So let's have a look again. Here we see the initial situation, a nominal value of 1 million euro with an interest of Euribor plus 2.5%, and we have a hedging instrument to exchange that towards a fix of 3%. At inception, the Euribor is at 0.5% plus 2.5, which makes the variable the 3%, and that is the fixed percentage they hedge to their swap, interest rate swap. Moving over time, Euribor is increasing, so the variable is increasing as well, which is the amount you're paying, but the delta is offset by the interest rate swap you have, which fixes it at 3%. And according to the increase in the interest, the Euribor, your fair value of your swap is evolving. What happens initially? At inception, the swap has no value because the fixed rate is equal to the Euribor plus the variable spread that is added to that. We move to 31st of March and we recognize an interest expense of 30,500, which is basically the 0.55 Euribor plus the spread that is added and is expensed. Luckily, we have our interest rate swap, so the delta is cash back on basis of the interest rate swap and is recognized not applying hedge accounting in your P&L. Here in the example, we recognized it also on the expense line, which would the offset then be a net 30. Obviously, then you come to the common IFRS rules. If the counterparty is the same, then you could have an argument to account for it in minus of your interest expense. If the counterpart is different, it might be that you need to recognize it as a financial income. Your financial asset becomes worth more by 1,000, and then you will recognize as a financial asset through P&L, so you have a gain of 1,000 in P&L. Applying hedge accounting, similar happens for the cash. You get 500, it goes to interest expense here, but the fair value of your financial asset is not recognized through P&L, but is recognized through OCI. We have a similar situation at June 30th. What happens here? You pay a higher interest because the Euribor has gone up again in both situations. That's an interest expense towards cash. And the delta you get back through your interest rate swap is a cash you get in, recognized through P&L in both situations. Different now, not applying hedge accounting, what will happen is your financial asset will increase, but and it's recognized through P&L. Applying hedge accounting, what happens? You also get an increase of your financial asset, but not the full increase goes through OCI. Part of the increase of the financial asset is linked to the change in credit risk of your swap counterparty. So what happens is that the change resulting from the change in interest market rates is recognized in OCI. The remeasurement resulting from the credit risk is through P&L. It is here the situation was also there, but given that it goes in minus, your evolution of interest rate swap will be offset and is capped at 1,000. That's similar to the underhedge and overhedge situation we explained earlier. You will only recognize in one direction. Moving forward to September 30th, we again see an increase in your interest rate, which is offset by the cash back you get from your interest rate swap. And then it's fully related to the increase in market interest rates, so it's fully recognized in OCI for applying hedge accounting, or in P&L applying not applying hedge accounting. What is the final outcome applying non-hedge accounting? Is basically you get a net interest expense of 90,000. It could be that the full interest expense is higher, but then it's offset by financial income, as said before, towards an actual cash out of 90,000. Your financial assets will have gone up by year end to 4,500, and that ran fully through P&L. That is one side. And then here, applying hedge accounting, what happens here is you basically get also the net 90, but your financial asset will have gone up partially through OCI and partially through P&L. And I think I made a slight error here, because obviously it is an expense that is partially offset by a gain. That is the net P&L. In here, it's similar. The expense of 90 will be partially offset by a gain here. The delta here is still OCI, which will be recycled when the full financial instrument settles. So that way we had a few examples on what is the difference on applying hedge accounting and non-hedge accounting for a fair value hedge, and also a specific situation of cash flow hedges. What happened for hedge accounting of a net investment? Basically, it's recognized at fair value. The effective portion of your hedge instrument will be recognized in OCI. At the same line, your CTA is recorded, because your net investment also will correct through CTA. The ineffective portion goes through P&L. There is a reclassification to P&L when the foreign operation is disposed of. What are the minimum documentation requirements we have using hedge accounting? And it's a bit re-summary of what I've said in the beginning. It all starts from the risk management objective and the strategy. So you will need to have a risk management strategy, which is good reference to a formal policy document, and also the objective, where you specify what will be the desired hedge relationship. For your hedging instruments, it's quite elaborate, so it's important to be aware of that. It's not fully disclosed in your financial statements, but internally it should be available. The specific identification of each of the hedging instruments, also, if applicable, obviously, the specified proportion you will design, exclusion of time value forward element or foreign currency basis, and then whether you apply a rollover strategy or a dynamic strategy. Looking at the hedged items, also you need to identify the specific hedged items to determine whether the hedged item has occurred. If applicable, you only specify the proportion or a layer, and also the specific risk component should be documented. If you only designate a specific contractual cash flow, you will need to designate those and document that as well. And the expected timing and rationality why you think forecasted transactions are highly probable. Also to be documented is the risk being hedged, the hedge type, specific identification of risk, and a designation of a one-side risk. So hedge type would mean a fair value. Is it considered to be a fair value hedge or a cash flow hedge, or is it net investment hedge? And also a documentation requirement is approach to effectiveness assessment. So why do you consider there to be an existing economic relationship? How was the hedge ratio defined and how determined, especially if it's dividing from one-on-one? What are the effects of credit risk that have been excluded and how was it determined? Assessing effectiveness qualification criteria, and then the sources of your ineffectiveness and the frequency you will do the assessment. And eventually date and approval of signature. It is quite extensive, the documentation, but as explained, applying hedge accounting does give some advantages if you look at your financial statement. The example we gave from the fair value hedge, clearly you don't have the mismatch that your higher asset base results in a higher charge over time compared to a one-off financial income from your hedge instrument you used, because you offset it directly on the asset base. For the cash flow hedges, the examples we gave clearly demonstrated that applying hedge accounting, your net revenues will be higher than not applying hedge accounting. Simply because not applying hedge accounting, a larger part goes to your financial income and results, whereas applying hedge accounting, that variability is pushed into OCI during the lifetime, and upon realization and effective taking place of the cash flows, the portion buildup in your OCI can be recycled back to your P&L and towards revenue. So you have less fluctuations in your operating lines like revenues and less in your financial results applying hedge accounting, which is not the case not applying hedge accounting. Obviously, in different situations, it might not be on revenues, but on other line items of your financial statements, given that there is a huge variety of hedge instruments in place. I think, and we're a bit ahead of time, that was our hedge accounting webinar. I don't think we have anything left. So from my side, the only thing left here is, as explained by some, our next webinar. But obviously, if there are questions, I'm willing, obviously, to respond to those.
There are no further questions. You're thanked, Hans, for the interesting seminar on this complex topic. So, okay. I think that's it. Thank you very much, and hope to see you February 25th. And then also we will share with you the schedule for our webinars for 2021 in the coming year about other topics. Thank you. Have a good day. Bye-bye.